Very good morning to you all. And thank you, Cafemutual, for giving me this difficult opportunity to explain on markets. As this suggests, there are many questions. There are very few answers today. But I think we have to look at it from a different angle that maybe only a few things will count finally in what we do. So the whole idea is just to take you through, what we as fund managers potentially are thinking and seeing in the markets and share it exactly like that rather than saying what will happen to markets in the next 12 months. So nothing could have been better than this, right? I mean, you've got an extraordinary period, perhaps one of the strongest bull markets we have seen in 2 decades, right? But more importantly, all this makes one thing clear. We are starting on a high, right? If you had put money in anything in the last 3-4 years, you would have made tremendous amount of money. But today, if you allocate wrongly, I think the next 3-4 years will be very, very difficult. So I think the whole interesting thing today is to note that we are starting on a high. Nothing is easy from here on, and nothing is going to be how it has been in the last 3 years. So in our reading, next 3 years will again be entirely different from what last 3 years have been. It's not necessarily that we'll crash or correct sharply or whatever, but clearly the return expectations cannot be there. The whole idea and expectation that everything will go right from here on, there is huge, I would say, euphoria around what's happening today in terms of markets. But I think this is just a rethinking of what the markets can possibly offer. So it's very clear there is nobody here wanting to invest in anything but equities. Right? Or debt बोल के class होती थी, people have forgotten. And FD, अगर कोई FD में उसका पैसा रखा हुआ है तो उसे दुख हो रहा है आजकल कि बस मेरा returns नहीं आए. So, and this is not, please understand, not a problem of small investors. It is a problem of small investors, mid investors, large investors, and everybody is caught in this cycle. So if you tell someone that just be careful with your money, they don't want to listen. And I think that is where, as advisors, all of us come into play, right? Clearly, fund flows everywhere are overshadowing at least near-term fundamentals. And they only happen when fundamentals are good. So fundamentals are very, very good today, right? But valuations are capturing a good part of it. So this is where I will just discuss the next 10-15 minutes which are there. So India, a couple of years back, was 3% of the world market cap, right? I mean, that was a very small number, and as people said, will be higher. Today, we have done exceedingly well versus the world, and we are now about 5%, 4.5%, 5% of the market cap. This is fairly large, right? We just cannot keep going on like this. So if this chart extends for the next, say, 6, 7, 8 months, we will become maybe a much larger part of the global market cap, which I think is at risk. So please don't estimate, extrapolate this chart, at least in the near term. Maybe in the medium term, it will all work out, and I'm sure it will work out. But I think the narrative is as simple as, say 6 months back, our market cap was, say, $5 trillion. After that, in about 2 or 3 months, again, it moved to $5.5 trillion. So if it goes at this pace, in at least a few quarters, will suddenly become some $7-8 trillion market cap, maybe start benchmarking with, the top 2-3 economies in the world. Right? So I think please keep your expectations under check because this is just blowing up. And this is what the flows I talked to you about. All of you know, all of you are beneficiaries of it, but you don't know the scale of it or the context of what's happening, right? So when we meet advisors today, we get only one thing. Client wants to put in money. Even if we tell him, be a little conservative, put it in a staggered manner, the client says, thank you so much, and he puts in money directly from somewhere or the other. So I think that pressure of flows, the flow of money is tremendous. And this only happens when people forget to assess risk appropriately and write checks blindly. So I've seen whenever people write checks blindly for equities, you have to be extremely careful. And all of you know, a few years back, people had difficulty in writing checks for equities. That is where the next 3-5 years are very, very good. So I think these are times to be rational in terms of whatever money flows. So what is the narrative today, right? This money will keep coming in, markets will not correct. Because money is coming in, markets will not correct. Because markets are not correcting, money will keep coming in. See, I think we are trying to take this narrative a little further than ever, and it is a good time to reassess because the returns have been extraordinary in the last few years. So today we get about $40 billion annual run rate of equity money in just an SIP format, which is large by any standards, and that is forcing global multinational companies wanting to list in India because they want to capitalize on this. So this whole narrative that only money will drive valuations is not the answer now after the whole rally which has happened, because you will find somebody sitting somewhere in the world creating supply for that money, and which is happening as we speak. But all this happens in a strong bull market only. So our balance sheet is good as a country, our individual balance sheets is reasonable, corporate balance sheets are fantastic. So there is just no challenge from on that front at the moment. So somebody asked me, it's a very interesting question. Every time there is a problem in the markets later on, something bursts, something gives up. And that generally is leverage, right? So where is the leverage today? You don't see all balance sheets are good, so we don't have a balance sheet problem anywhere. The leverage today is in investor's mind. His return expectations are running extremely high. They're running at 20%. I don't think you meet any investor who says he wants to earn less than 20%. So if you say that return is not possible, he say 15 is okay. But I don't think anybody is coming with a view that they can even have a time and price correction in these markets for the next 2-3 years. It means a lot of decisions are coming out of last 3-4 years of returns. And 60-70% of investors are very, very new. They've just not seen a down cycle. And we call them investors. Because they've written a check, we call them investors. A true investor is someone who puts money, sees his money decline by 20-30%, stays there for 2-3 years, and then gets a benefit in the next 5 years. So I think these guys have not yet been tested by the market. So I think the role of advisors becomes even more important. But that's another matter, in a bull market, nobody listens to anybody. So that's the change. Simply put, these numbers, the mid-cap indices are nearly 35 PE multiples today, and at least 50% premium to long-term averages. It can go to 60, 65, 70, that's all possible. But when we allocate money, just be careful that we are not allocating. See, we have seen these cycles. आज आपको सेक्टर थीमेटिक्स में ब्लाइंडली पैसा आ रहा है, राइट? कोई भी सेक्टर थीमेटिक फंड में ब्लाइंडली पैसा आ रहा है. क्यों आ रहा है? पिछले 3 साल का रिटर्न अच्छा है बोल के. And newspaper articles are good saying 1, 2, 3, 4, this is, these things are happening. So everything is on the face extremely positive, and that is getting priced in. So while things are good, what you pay is the single most important decision, and I think that's important. So these kind of premiums were never there in a long, long time, right? It means if this premium were to be applied to Nifty, Nifty should be trading at 35,000-40,000 or 35,000 of levels versus here. So it's a sizable premium in select pockets of the market. And these are not mid-caps, this is a mid-cap index. But these are companies with 30,000 crore market cap to 90,000 crore market cap. These are sizable companies, and their growth rates cannot be very, very high. Because for a 30 multiple, on a sustained basis, the earnings have to compound at least 20% plus for a long period of time. Why? So there is one narrative which we also hear, and how much ever we explain, the basic question is, do valuations really matter? Market to badhte hi rehta hai, so do valuations really matter, right? So if you look at it in the context, every bull market this question is asked, and every bear market this is the only thing people come back to, right? So it does, and it does matter when this frenzy goes away, and when the frenzy remains, you will find that the people give up simple frameworks which they've been using for years. So let us just put it like this, right? The single biggest mistake in life is overpaying, and overpaying for anything. If you overpay disproportionately for anything in life, it hurts. So people overpaid for gold. 10-year returns of gold till recently were in dollar terms at least flat. So anything which you find there is a frenzy and where there is too much of money chasing it, you just have to be careful and be more balanced at that point of time, is what I would want to really reflect. You looked at, say, 4-5 years back, very interestingly, you would find there's only this narrative that quality companies at any price. What happened to that narrative, right? Suddenly those have become forgotten blue chips in 4 years. And these are world-class businesses. When you look at other narratives which were there, in each area there was a narrative. There was one narrative that online companies will disrupt everything offline, right? Today, offline retail is growing faster than online retail in India, in the same country. So any narrative you're building with a 3-year, 5-year kind of an horizon, it just works inversely. And even for banks, for example, the narrative was fintechs will kill banks, right? Just about 2 or 3 years back when these banks used to trade at very low multiples for XYZ reasons. So I think the logic is wherever these narratives are working. Today's narratives is valuations don't matter, keep pumping in money, and money will solve all our issues. So there are many examples over the last 3 decades. I mean, you can just look at all the cycles we have seen. It takes 10 years sometimes if you go wrong paying expensive valuations of 70, 80, 90 multiples. And today in many pockets of the market, we are paying that, right? So when you look at sensibly where to be positioned, I think there are some areas which are still okay, but there is no easy money lying anywhere in the market. See, today, sitting here, each one of you will have 5 stock ideas, right? Everybody has an idea today. Every Indian company has a story and potential suddenly, right? Just 3 or 4 years back, you had this challenge that the no company in India had a story virtually, right? Because there were so many challenges, this was it. So I think both sides were wrong. I think it's our mind which is building a story in every single business. And a lot of investment banking is building a story because in every single IPO has to be subscribed. So I think there is huge narrative happening. So just be aware of this aspect that when you have these kind of stories, you are already paying well. And paying well for the best businesses in the world is also a challenge. Another interesting thing is we meet companies. This narrative, one more narrative is like, I talked about money coming in and markets won't come down. One interesting point I just want to mention, we meet companies every day. So virtually most days or many days we meet companies who want to raise, just 2 or 3 companies will come to our office and we'll meet them. They want to raise 10,000 crore rupees. 12,000 crore rupees. Single company has raised 28,000 crore rupees, right? Largest ever IPO. So as much of money will come in, you will find there will be supply. So just don't buy this narrative that because money keeps coming in, stock prices can be bid higher to any level. I think it happens in phases, but I think it's self-correcting. I mentioned about multinational companies wanting to sell their stakes, right, of their Indian businesses in India, which I remember 10 years back, they never wanted to even meet Indian investors and do an analyst call or conference call here, saying that it's too small a market, right? But today when they are finding our valuations 10 times more, 5 times, 7 times more, so a company with 4 or 5 PE multiple in respective markets, today are finding their India business is valued at 20 times, 25 times, and they want to sell. And this is now a plethora of companies who have done, at least 7 to 10 companies have done. So just be aware that somewhere or the other seller will emerge. So the basic narrative that there is no seller or there won't be a seller in the market is, I think, a question which I have to be careful about. This is just one point which tells you where possibly we are. We are somewhere in between, right? On the left side, you will see the red one is the business value. And then there is speculation. This is very normal markets. So you'll have a business on which some speculation happens based on future potential. Today, in many pockets of the market, what's happening is you are seeing there's a business value, but the speculative value of this business, that the potential in future is way, way higher than the underlying business value. So for example, when you do a DCF, if 90% of the value lies in the future timelines, right, and is not visible in the next 5-7 years, I think we are taking a lot of risk because businesses change far more quickly than you can perceive today. And this nobody talks about and nobody wants to hear. Earnings are weak, at least at the moment. But I'm sure earnings will recover. There'll be a growth story. Earnings will come back, but will they come back at 15, 17, 18% compounding to deliver returns for you? I think if I simplify this, I say the PE multiple re-rating story of India seems to be very, very well done. I think now it's earnings which have to come back to deliver returns to all of us. And I think only earning-led returns might be possible. Today there is this is one I think which is very useful for all of us, is there is, wherever misallocation is happening of capital, that is where the value of advisor or all of us comes into play, right? I mean, you put in a sense that this is possibly not the right thing to do. There are a lot of times advisors tell us that nobody is listening because of the nature of the markets, right? But I think what you do today determines your relationship with your client for the next 10, 15, 20 years. If a client stays with you in this cycle, I think just that value it adds to your business over the next 10, 20 just goes up dramatically. So I think it's about doing possibly the right thing at the right point of time. These are all the signals of excesses I've talked to you about, right? And all of you know, all of this is happening in front of our eyes. So I think we just have to be aware that that is the reality. So people say, what are the risks? So anybody we meet, whether it's the largest corporate CEO or any investor, any partner, any distributor, we don't see a risk. What will bring this down? I think the beauty of risk is this, boss. Whatever gets seen and known gets priced in. And because it's not visible to us, right, it will always be, like we say, unseen, unknown, and it can be camouflaged. So just be careful. See, this does not mean you have to sell all equities and sit quietly. The whole idea is very clear. Optimize what you are doing today, because today you are doing by your choice. If things turn badly in the next, say, some period of time in certain pockets of the market, a lot of people will optimize by force. And I think the idea is if you do it today, the outcomes will be way superior for clients and for everyone. So what do we do? Right? What do we do? So as a fund manager, we do a few things, right? Which is attempt not overpaying for growth. It's not easy in these markets. Sensible diversification, again, that's possible, but I think it impacts returns in a momentum market. In cyclicals, we do is choose category leaders there, because if there's a problem, these guys will do better, right? We reject unexplained valuations, right? I mean, that is one way to avoid. And we believe that, when there is so much of good news, I think these are not bad. These are actually not good prices to invest, but bad prices to invest. So we use this as a kind of a checklist to see, where we are putting in money. But there's something advisors can do, right? I mean, this is where I think this is, if at all there is a time for real value addition, it only happens in bull markets. It only happens in a bear market kind of a scenario for advisors. So I think the whole question is, what choices all of us make today will determine what our business will look like in the next 10 years, 15 years, 5 years, 7 years. Most relationships are made at extremes, right? And they stay longer if you're able to get the advice right in that cycle. And I'm sure investors will not listen, but they will respect what value and what advice you would like to bring to people. A few answers. I think I'll certainly said I'll have a little bit of few answers left to the whole discussion. So please be careful of unreal expectations. Leverage is in the mind of investors. So when you have a conversation with an investor, and if you tell him to diversify or put into debt or put somewhere else, you're always finding a resistance, right? And that, I think, is nothing but they have unreal return expectations from equities. You may still have it for some period of time, but when it turns, end of the day, the investor will say that the advisor has not advised appropriately. So you just have to be careful of that. In some categories, please expect losses to be made. No single investor today is investing in equity after such a rally and coming for or having even expectations of a negative 1 year. Right? So I think we should be very, very careful that people are writing checks with that view in mind, and hence possibly they write checks to a little more areas which are more conservative. And the rest of the things I'm sure you're all doing. And basically there is no leverage while investing in equity. So I think we should not in any way attempt, there are a lot of products which have, loans on mutual funds and things like that to again put into equities. I think they will add to the pressures which are there. And lastly, if money comes in and investors are looking to put in, what are the classes to be there? Large caps, far more sensible than most other places, far better risk reward than most other places in the market or any large cap bias portfolios. Asset allocation portfolios are far better. Large caps, for example, as a category are getting only 2,000 crore rupees out of the net 40,000 crore flows which are coming on pure large cap basis on a monthly basis. It just reflects it is an under-owned, under-invested, or possibly under-captured market, and possibly the risk is a relatively little lower there. And no money for equities should be put in for the next 1 to 3 years. In the sense, at least have a horizon for them of 3 year plus to come in. I'm sure everybody will say that, but even then you stagger it and see, because at least a horizon of 3-5 years to make even a normal reasonable IRR is what one should look at. Rebalancing, I think today nobody wants to sell. This is the time to take some profits off and repay housing loans, repay whatever, or at least commit or take out committed capital for the next 3 years out of equities, which one should do, ideally. So that is one holistic thing which is there. And this is the time to lower risk, not to add risk. So these are a few things I wanted to say. I kept it a little away from the market valuation and multiples because all of you know about it. And it's just that the context of where leverage lies is actually on investors' minds, where they are coming with very high return expectations. And that's where I would request you all to be very cognizant of the fact that we are pricing all the good things well. And we also hope that this continues as long as it can. But I think the longer it continues, the chances of outcomes being inferior in the next 3 years, 5 years become real. So this is what I just want to share. So thank you so much. And thank you for having me here. Thank you.